Are you about to start a podcast or producing a podcast and tired of doing the editing yourself? We have produced over 1,000 daily shows, and the production team that I've created, they're now available to produce shows for you as well. We can do as little or as much as you need, from finding and communicating with guests, preparing introductions, to editing the audio and video. You will sound better, have a more professional presence, and be able to spend your time doing other valuable tasks on your business. Let me know you're interested by emailing me directly at whitney@lifebridgecapital.com.
This is your daily real estate syndication show, and I'm your host, Whitney Sewell. Today is a highlight show that's packed with value from different guests around a specific topic. Don't forget to like and subscribe, but also go to lifebridgecapital.com where you can sign up to start investing in real estate today. I hope you enjoy the show. Our guest is Matt Picheny. Thanks for being on the show, Matt.
Thanks, Whitney. It's a pleasure to be here.
Matt is a managing partner at MJP Property Group, a real estate investment company. With over 15 years of experience, he has invested in over 5,000 units and is primarily focused on acquiring and repositioning multifamily communities. Matt, pleasure to meet you. Pleasure to have you on the show. Thank you again for your time. Give us a little more about your background in real estate. And I know, a lot of our focus today is going to talk about your journey, because I know you've made the path or the journey that I think a lot of the listeners, or numerous listeners, are contemplating as well. And so I think they're going to relate to you and your story. But let's go back to, how you got into real estate, why multifamily, why investing in syndications?
Yeah, sure. Well, if we go way back, I grew up in Florida and I moved to New York City to pursue a career in theater, which is kind of an interesting background for someone who's involved in real estate. But I did that professionally for about 5 years. I was an actor doing shows all over the country. And then I went from there into segued into digital marketing, the digital marketing world, and worked in, corporate America, climbing up the corporate ladder for about 18 years in New York, working at different advertising agencies. During that time, I started tinkering around a little bit in real estate, first with a purchase for my own primary residence, and then it expanded from there. I ended up purchasing some land, a vacant lot in Connecticut, and then eventually I built a house there. And then that house ended up, the intention was that it was going to be a vacation home for myself, and the costs were a little high. So I thought that I could defray some of those costs, at least at the beginning, with doing some rentals. And what ended up happening with the property very shortly after it was done being built was it became a full-time rental property. And that taught me a lot. And really kind of put me into a position where I really started to understand real estate, really started to understand the rental market. At that point, I started to diversify into some other things. I got involved in some single family homes, some fix and flips. And then there was a move. My family moved from New York to Miami. What happened was my wife got a really cool job opportunity. It was too good to pass up. And that was the time that I left corporate America and we moved to Miami. And while we were in Miami and I was doing these single family properties, I was trying to figure out, how do I scale this business? And for me, and then there are people who can scale a fix and flip business or a single family business. But for me, what I was looking at, what my goals were and the lifestyle that I wanted to have, I found that multifamily was a much better way to go. So that's when I transitioned into doing multifamily. And that's when I transitioned into doing real estate full time, was upon that move to Miami, which was about 5 years ago. We were in Miami for 2 years. We're in Boston, Massachusetts now. We've been here about 3. Once again, my wife, completely out of the blue, got recruited for another job up here, which is why we moved here. But we do love the Northeast. And I'm doing this full time now. And I started off, I always had an intention to be active, because I had the experience being active, whether it was in the building of the vacation home or the single families and the fix and flips. I was never the guy doing the actual construction with the hammer and the nail, but I was definitely very involved and very active in these projects. But when I first started getting involved in multifamily, especially while looking for those first deals, what I did was I started investing passively in a number of deals. And the main reason for that was because I learned a lot from watching those other owner operators and seeing how they're operating the properties. So I got a lot of experience sort of through osmosis as being an investor. Plus I got the cash flow from those deals when the deals performed well. So that's been a great thing. And I've also then started investing started working as a syndicator, as a sponsor on a number of deals. And so I have a bunch of doors that I am now the syndicator on. But, you mentioned earlier, I have, over 5,000 doors that I've invested in. Just to be really clear about that, only about 20% of those deals are deals that I'm decision maker, principal, on that deal. The other ones are completely passive investments.
So getting started in syndication, though, was that something that at first you were like, oh, wait a minute, if I can't, I've heard this from other operator or other investors at first too, especially if they have operated some property, they want to be active. It's like, wait a minute, I'm not going to invest in some other real estate deal if I don't have any control over the deal. Was that really your thought process in the beginning and that had to change, or did you just understand the business model from the beginning and know that was the way you needed to go?
It's sort of twofold for me, right? So on one hand, at that time, I don't know what I would have done if I had control, because I didn't really know what I was doing. I knew how to do the single family thing, right? But I didn't know how to do a larger multifamily syndication. So part of it was learning. I was going to people and investing with people that have a track record, that have been doing this. And I'm sure you've heard this, Whitney, and maybe people have said this, and any listeners have probably heard this a lot. People that that you like, and that you trust, right? This is all people that I had gotten to know, not some random person that I met at a random meetup or heard on a podcast once, but people I was able to sort of build a relationship with, get to know over time before I handed over a lot of my hard-earned cash to invest in one of these deals. And they also had a track record of being able to perform really well. So I knew that they knew what they were doing. So I had confidence in them. And I also knew that I would learn a lot from listening to them while I was continuing to learn. And I joined a mentorship group and did education and all these other things all at the same time that I was doing these passive investments. So that's kind of from one perspective. From the other perspective, when we moved to Miami, I was fortunate enough to be in a position where my wife had a really good job, and I had saved a lot of money working 18 years in the corporate world in Manhattan, and I had also invested in a number of real estate deals. And also my wife is involved in the theater. So we had invested in some theatrical Broadway shows that were doing extremely well at the time. So we had a good amount of passive cash flow that was coming in. And so for me, it was about how do I amplify that cash flow? So for me, it wasn't about, well, I need to control a deal or I need
Was that all from your passive investments?
I had a number of passive investments of cash flow coming in from that. It was not enough for me and my wife, for our whole family, to live off of just those passive investments. I mean, maybe we could have eked it out, but also some of them, especially when you have, we were involved in a Broadway show that was doing really well, and it's continued to do really well. But that at a certain period of time, and who can really predict that, it will start to decline. So we didn't want to count only on that. And we had other sources, right, of passive income. And so my idea was, how do I go ahead and how do I grow that passive income and diversify it into different things, real estate, and not only real estate, but real estate in different markets, right? Am I going to put everything in, Dallas, or do I want some things in Atlanta and Florida and, Ohio or Kansas, Missouri, whatever, all these different states, all these different places, different markets, because if one market's doing well, another might be doing poorly. So I wanted to kind of diversify the real estate and diversify it across different operators. So that's what I did. So my goal wasn't, well, I want to start syndicating deals, so then I'm getting, syndication fees, which are, I do take on deals that I'm a syndicator on. I mean, I put a lot of hard work into it, as you know, Whitney. You syndicate deals too. I mean, there's a lot of work that's involved in this. So you do get compensated for it. But for me, it wasn't about building that up. It was about building the passive income up. And that's what I've been able to do, such that, if I don't syndicate a deal for a year or two, it's not that big it's not a problem for me financially. I can really make sure that I'm waiting and choosing to get involved in deals that I think are really good deals.
Nice. So, why don't you speak to some of the success tips that you would have for the passive investor that's listening right now that really wants to be an active operator down the road? Some things that you did, or maybe things you learned, maybe things you see now that you shouldn't have done, however, that you wish you would have known back then, knowing that, your immediate goal or eventual goal is to become an active operator.
Yeah. So for me, I think that it's all about relationships. It's a big relationship business. Okay. So now if you're looking at, I can talk about that from the passive perspective and then getting into the active perspective as well. So from a passive perspective, a lot of these deals that are being done are done with the 506B compliance. So what that requires of the syndicator is that the syndicator has this pre-existing substantive relationship with the passive investor. So you as a passive investor, building those relationships, getting to know and meet different people, different syndicators, and developing that relationship is great. I recently just did a deal, and one of my investors that I've known for a little while was like, hey, my friend wants to get involved. Can they invest in the deal? And I said, actually, the deal's already under contract. I can't do that. But why don't you introduce me to that person, which he since has. I've had conversations with her. I've gotten to know her, understand her. She knows me. She understands me. So now the next time I have a deal, she can invest in it. So building relationships just with other sponsors, I think, is really important from a passive investor perspective, so that you can, number one, be eligible to invest in their deals. And number two, you can get to know them better. Who is that sponsor? You're putting a lot of trust in them as a passive investor. And you want to make sure that that person is going to be a good steward of your capital. So that's really important. And then as we move into talking about relationships for an active person, someone who wants to syndicate deals, it's about developing relationships with the passive investors, because you will be raising capital probably for these deals unless you're independently wealthy. But also, how do you get those deals, right? And so there's sort of two ways. One way is through developing relationships with the brokers and the property managers. That's the route that I've taken. So I pick certain markets that I might be interested in for one reason or another. And then I go into that market, and it usually takes a couple of years to go in, establish myself in the market, get to know all the brokers. There's Pareto's principle. It's the 80-20 rule, which is basically, this applies to many different things. I was first exposed to it. I'm a project manager by trade. When I worked in advertising for 18 years, I was a PMI certified project manager. And part of that certification process, you learn many things. The Pareto's principle is one of the things that we were taught. So it doesn't just work for real estate, but the 80-20 rule, it's basically 80% of the deals in a market will be done by 20% of the brokers. So there's really only a few of the real estate agents or brokers that you need to get to know. But it's good to know all of them, but most of the deals are going to be done by a small amount of them. So you need to develop those relationships with the brokers and also with the property managers. The first deal that I ever got as a syndicator was because of my relationship with a property manager. And they were people that I had met in the market. I had been working with them, and I had been looking at a number of real estate deals. And when I got to the point where I was ready to make an offer, I wanted to review it with the project management company. And during one of those conversations, they said, oh, by the way, one of our clients that we know is looking to bring a property to sale, bring it to market. Would you like us to introduce you to that broker? And I said yes, and it was really good because that broker was not one of the 20 that does 80% of the deals. This was a very small independent broker who doesn't do a heck of a lot of volume in that area. I never would have met the person. I met the person. I ended up with the deal. That's a whole other story. But that just talks about building those relationships. That's really important. That's the one way. The other way is through developing relationships with other sponsors, right? So Whitney, you and I have started to get to know each other. We're actually in a big mastermind group together. Maybe one day I'll have a very interesting deal that I like that might be a little too big for me to do on my own, right? It's a 400 unit deal. And there's just so many different moving parts. And I don't have a full staff of people working for me. So maybe I need to leverage you, Whitney, and your experience and your team, and we can partner together and therefore take down a deal together. So that's another thing about developing relationships. But it all comes down to passive, active, whatever the situation is. It's a relationship business. And that's, I think, the most, if there's one key takeaway from this podcast, I would hope that would really sink in for people.
Definitely a relationship business. Can't stress that enough. No doubt about it. Well, Matt, that first deal when you became an active operator, was that partnering with another operator that you had invested with passively before?
Yeah. Oh, so that's great, Whitney. And you're actually bringing out a little thing that I failed to mention about the partnering with other syndicators. And so this person that I brought on, I'm trying to think about it because I've invested in deals that he's a sponsor on, but I don't think I had yet at the time. But this person I met through a mentorship group that I was in, and this person had done, I think, about 10 syndications with about 4 of them having gone full cycle. So this was someone who was very experienced, who really knew what they were doing. And I had been talking with them. I had known this person for about 2 years. And I had been looking at deals and reviewing deals with him for quite some time. So we were very synced up with one another. We had actually had a couple of letters of intent that we had submitted and made to a couple best and final rounds on some other deals, both in the Kansas City market, which is where this was, or also in Florida. We had looked at some deals and gotten into best and final there as well. And so we had developed a great relationship. And I had KP'd on a previous deal that's a key principle. You've probably talked about it on your show before, but just for those who maybe have not heard, if you get agency debt like Fannie or Freddie debt, you can sign on as a key principal, and that sort of gives you some credibility to be able to get one in the future. It's kind of hard to get one if you haven't already done one in the past. So that's why a lot of people will be a key principal on a deal, signing as a guarantor on that loan. It's a non-recourse loan, but there is a bad boy carve out where it could become recourse if there's any sort of fraudulent activity that happens. So you are putting your name on the line, signing as a guarantor. I had already done that once before, so I had a little bit of credibility, but my partner, having done that many, many times, that allowed us to definitely get that agency debt. And also he has the track record, which was great. I have a number of people that were interested in investing in my deal. They knew me. They knew I had been involved in real estate from a part-time perspective for about 10 years and then full-time for 2 years. They knew who I was. I had done business with, they were either friends or business colleagues. So I think they had a lot of trust in me, but just having a co-pilot on board who had a ton of experience really just kind of, if they were on the fence, kind of tipped them over the edge of the fence and let them have the confidence in the deal. And so that was key. I don't know that I would have been able to do that first deal without him as being my partner in the deal. And we have subsequently done a number of deals together. We have a great relationship, and it's been a wonderful partnership.
Our guest is Luc D'Abreu. Thanks for being on the show, Luc.
Yeah, definitely. Thanks for having me, Whitney. Looking forward to getting into it.
Luc's educational and professional experience is in the architecture, engineering, and construction industry, and he has been involved with projects valued at over $750 million over the last 9 years. He's a limited partner in 445 units across 2 assets in Texas, totaling $36.8 million. Is part of the National Black MBA Association and African American Real Estate Professionals, and holds a master's in engineering from UCLA and soon an MBA from the University of Illinois. His goal is real estate is to create generational wealth, leave a legacy, and provide a better life for his family. And we're going to hear today just some of the things he's done to get that started, especially investing as an LP in a few deals, things he's looked for. We want to learn from his experience and how he chose, whether it's the GP or the market, in different ways that he has been successful that in his path moving forward. So Luc, welcome again. Grateful for your time and being willing to share your experience and expertise with us. Give us a little more about your background and just getting into the syndication business and why, why invest in syndications? Why was that right for you all?
Yeah. So, when I had finished grad school, this was back in 2012, I ended up reading the famous purple yellow book that everybody references of Rich Dad Poor Dad. And so I had kind of had things on my radar in that way already, just being able to do more than simply work in order to have income. And I saw things like that growing up as well. I had some exposure to that, but I didn't really have any sort of framework or plan to move forward with that. And so, reading that kind of definitely shifted my mentality a bit, Whitney. And then I continued to just get education and learn and read books. And then podcasts back then weren't nearly as big as they are now, but maybe 5 years ago podcasts were. And so that kind of helped along the way. And I had an opportunity to invest in a couple of those deals out in Texas, like you mentioned. And I knew it was the right time and wanted to move forward with it because, I'd been preparing for it. I'd been waiting for it for so long at that point, it felt like. So I jumped into those and the rest is history. And I'm still involved in both of those deals. They haven't gone full cycle yet, but those are doing well and looking forward to investing in more.
Nice. Well, let's jump in there a little bit. And I'd like to even back up and say, how did you know where you were ready? Why was it syndication? I know you've been educating yourself, but you could have invested with a single family operator, or you could have invested in land or hospitality, or, there's so many other avenues, right? Or in the stock market even. Why was it, syndication? And I assume it was multifamily because we share the units. Yeah. And so, why that specifically?
Yeah, so I never ended up doing a 401k. I was 22 and I started out working. I didn't do the 401k because I didn't understand it. I didn't want to put my money into something that I didn't get. And it didn't seem like anybody else at work really understood it. It seemed like they were just doing it because that's what you were quote unquote supposed to do. Now I understand what the heck's going on with those, but I'm a cash flow person and I need to understand what's going on and capital preservation. And of the different asset classes, whether it's in real estate or in the public equities that you just mentioned, real estate, specifically multifamily real estate, is the one that's able to provide capital preservation. It's something I understand, and it has that cash flow. Everything else, it can be a little more volatile. It can be a little more tricky. Something like single family, obviously. Land, it doesn't cash flow. So, that kind of met my criteria that I was looking for.
Nice. So tell us a little about you were educating yourself. So many people that are listening right now are doing the same thing you were doing, quite a few years ago now, and they're learning about the syndication business. And as they're looking to invest and grow their wealth, they're also trying to figure out, well, how do I trust this general partner? How do I trust this operator? There's so many of us have different qualities, right? That, we bring to the business, but how, and I just got off the phone with numerous investors, that ask different questions, right? Many are the same, but many are different, and they want to know how they can trust me, right? And so that's, we just want to show everybody that we can be trusted, right? But how did you go through that process, to say, okay, this is the operator I want to put my hard-earned money with?
Yeah, so the two offerings that I invested in were both 506B, and so there was a connection that both of us had. My former roommate had a connection to one of the lead sponsors on the deal, and so that was, that helped provide a bit of a sense of trust, of course. But meeting with him and talking to him, there's two partners, and meeting with him and talking with him, that ended up helping a bunch to provide some more, I guess, a greater level of comfort, right? So it's like, I wanted to be able to feel like, okay, does this person know what they're talking about, number one, but do they seem like they're a good person, could actually have a conversation with them? If we end up working or partnering together in some way down the road, is that somebody who I'd want to actually partner with? Like, can I talk to them? Period. Like, have a basic conversation. So that was honestly big for me. And then there's just a lot of due diligence. I mean, I checked I checked out both of the sponsors. I checked out the property management company. Like my fiance and I, we secret shopped both of the deals. We looked at the areas. Both of the deals are in San Antonio, and we weren't as familiar with them because we're native Californians. And so we went out there, we secret shopped them. We talked to the property manager and the leasing agents who were there. I wanted to see what kind of cars were in the driveway, all of that sort of thing. Like, at the very least, would I want to live here? Would I be comfortable living here? Do I feel safe? Right. And then the last piece was doing my own underwriting on them too. So I took the pro forma and ended up doing sensitivity analyses and just ended up checking like, okay, so how bad do things have to get to where this deal isn't going to work anymore? And because like I said before, I'm big on capital preservation. It's, especially when you're working. I mean, you I'm sure you're aware of this. It's like, it takes so much time and energy to end up actually collecting the money and keeping it, and you get taxed on it. Like, I don't want to lose it. So, because there's a bunch of time and energy that got put into it. So I wanted to make sure the capital was going to be preserved. And so with my own underwriting, that gave me a greater level of comfort as well.
Tell me about, how did you prepare for even like a property management conversation? Because how did you vet a property manager, and what was your thoughts behind that and just being prepared for that meeting, when you're really just learning about the syndication business?
I guess it was two things. There was a lot of digging I ended up doing online about the property management company. So I just did my own sort of, research, and that ended up helping, I would say, just to figure out, okay, well, how long have they been in this business? Is this, do they do well with value add properties? Like those were the sorts of things that I was interested in.
The next thing I wanted to ask you though was, you mentioned like underwriting the property and doing sensitivity checks and things like that. Well, that's kind of a more detailed thing too. There's a whole skill set around underwriting and understanding, the sensitivities of a specific property or business plan. And how did you educate yourself enough to feel comfortable, even underwriting a property like that?
So I looked at previous OMs before, and I had an understanding of the basics of an income statement at that time and how a DCF cash flow model works. So that ended up helping. But then the other part, what I ended up doing was I just took what they had as their pro forma. And so, I mean, to preface this, like I have a master's degree in engineering. So it's like, okay, well, I can work with a spreadsheet and I can understand some basics, right? I mean,
so you got a leg up already. I mean, that's incredible. Yeah.
Yeah. It was just like comfortable, being comfortable with like numbers at the very basics, but then being able to, work the basics of a spreadsheet, like nothing too crazy, of course, but just being able to work with that. And so I just ended up looking at a combination of the rent dropping and the occupancy dropping. Where does the deal not work anymore? Whether it's year 1, year 2, year 3. I mean, if it's year 5 at that point, it probably doesn't matter. So I kind of looked at those several years, and that's, I ended up diving in that way to do my sensitivity analysis. Like I said, if the money does what it's supposed to do and all the targets are reached, that's great. But man, I do not want to lose money. Like that's, it's like capital preservation. People invest a lot of the reason why people invest in multifamily and in real estate generally is because there is capital preservation. It is that hard asset, right? It's a very risk averse industry, generally speaking, compared to so many others. And so, that's what attracted me to it. And so I wanted to make sure that these properties and these investments ended up fitting that criteria for me.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.